right, here he is, Jeff Hirsch, editor of the Stock Traders Almanac. We've been talking about this, and we want to talk about, for starters, the Santa Claus rally.
Sure.
And I want you to help us understand, what is this thing?
Well, a lot of people use the term Santa Claus rally to refer to any year-end rally. It is actually something we created. It's the last 5 trading days of the year, the first 2 of the new year. There's a general bullish bias there.
So it's a 7-day span.
7-day period. It's a short period when there's a lot of professionals only, a lot of retail investors, individuals are celebrating holiday, festivities, and they're not as much volume. So it's an upward bias. It's after the tax loss selling is abated, and we see the S&P up about 1.6% over the years. But the significance is that when it does not transpire, it's usually a harbinger for lower prices.
And over the past 5 years, I think it's been up. We've had a Santa Claus rally for the past 5. We haven't had one. Talk about in the years, and in fact, there you go, some of the past years. It's, a lot of people think it's an automatic thing. It's really not.
It's not. And it's not so much that it's an automatic rally that you can make a lot of money on. It's something to look for as an indication for the market's health. So we saw, 07, 08, just before the big meltdown, 99, 2000, just before the big meltdown, in 05 and 94, it preceded flat years when there was no Santa Claus rally.
And I guess at this point, we haven't gotten yet to the last 5 days.
Yet. So it's something to look for. It's something to watch, in the weeks between Christmas and New Year's and the couple days after to see if the market's got enough power to take us higher.
All right, so then take it to the next step, the January effect. That's another indicator you watch.
January effect is tendency for small caps to outperform large caps in January. It has shifted over the years. It's been well documented in the Stock Traders Almanac that this effect actually, most of it takes place the last 2 weeks of December. We've seen the Russell begin to take off on Q around December 15th. It's up about twice as much, or as of yesterday's close, it's up about twice as much as the other broader indices. Again, it does take it on the chin a little bit harder.
And by the way, there's that seasonal pattern. And this is what you're talking about.
Yeah, this is the pattern. We compared the Russell 2000 to the Russell 1000, and you can see it starts a little bit in the end of October and in November, but then we see that real spike there the last couple of weeks, and the January effect really starts to fade in early January.
And
now.
Explain why small caps would tend to outperform large caps at the year end.
Well,
into the new
they
year.
tend to get dumped because they're a little more volatile, and they tend to be the bearers of tax loss selling, and that's part of that bounce where the selling abates, and they get gobbled up by the pros and other savvy traders that are looking for values and bargains, and it bounces them back higher.
So the January effect is actually different, though, related to another one of your indicators. You make the comment tax loss selling, and I read this myself. We talked about it, that if you look at stocks that make new 52-week lows at the end of December, what is it, by mid-February they tend to outperform?
Well, it's something we call the free lunch. It's a basket of stocks making new 52-week lows. It used to run from about December 15th to February 15th. It's really tightened, and we found that if we wait till triple witching Friday and use of December and use the stocks making new 52-week lows on that day, we get a bigger bounce. It usually outpaces the composites by about 5%, 10%, depending upon the year.
So what we should do is go back and look at the stocks that made 52-week lows last Friday. Those are our buy candidates. We buy them, and we outperform the S&P, at least historically anyway, by about 4 times.
Not quite. Through, you want to get out in mid-January most of the time these days. It sells
not
off
February 15th.
No, it's gotten a lot shorter. It doesn't last as long.
Okay, good deal. We got to talk about the presidential cycle.
Yes.
All right. So first of all, explain what the presidential cycle is.
Presidential cycle, the third year of the term, the pre-election years we call it, has been the best year of the 4-year cycle going back to 1800s. We have a chart we put together from 1949, which shows that it's up even more substantially, about 17%, versus 4, 5, 6% for the other 3 years. What causes this is the president's desire to retain the White House or to retain it for their party, so they prime the pump, which is a term that there's not a lot left to prime right now.
Yeah,
so.
and by the way, so year 3, that's this year. We should have been up 17.7%
on average.
On
it
average.
has been. There's been some other,
and we're flat.
Yeah, we haven't had a losing year for the Dow since 1939. There's been some other single-digit years. Right now, we're single digits for the Dow for the year. But what we found going into the presidential year, every year since 1896, when the Dow Jones Industrial Average started, that there was a sitting president running for re-election, which is somebody who took over from somebody who died in office, Johnson, or even Truman or Jerry Ford. We've seen an average 9% gain of those 19 times that there was a sitting president running, 14 up, 5 down. But only 2 of the 5 down have been really bad. 1932, when depression set in, and 1940, when World War II was raging over in Europe. So the others have been less than 5% losses. So it's a good thing that there's a sitting president, whether we like him or not, or whether he's doing a great job. If they get booted, there tends to be a rally in November, December, at the end of the year, or if he's doing well, the beginning of the year is a little stronger.
All right, so let's talk about, when the incumbent loses, right? Because that's a pretty big deal. Talk to us about that.
We see when the incumbent loses, especially an unpopular one, the market tends to rally, quite strongly in November, December, sort of ding-dong, the witch is dead celebration of there being, a turnover, so somebody better coming in.
So look at that. You actually, all right, Taft, going back to 1912, Taft lost, market rallied 7.6%. Ford out, up almost 18%. Carter out, up 15%. Bush Sr. out, up 4%. Hoover, market actually fell. What happened?
Well, that was the beginning of the Depression.
Well,
was,
fair enough.
Climactic changes, droughts,
a lot more going on than a presidential cycle.
Miscues. It was a global financial crisis.
So, in theory, at least with those examples, 4 out of the past 5 times when the incumbent lost, you had a rally. So, in theory, were President Obama not to get reelected, you would tend to have a rally.
Especially at the end of the year.
So you have to wait around for November?
Not necessarily. I mean, usually what you have is a popular president has the first 5 months strong, and then the last 7 months of election years are strong, regardless of whether the gentleman or potentially a woman wins or loses. But you tend to see some weakness during the summer week period, also when it's convention time and the campaigning heats up. So I'm looking for a pretty textbook year. I don't see a lot of upside above the 2011 highs. I don't see how we can push through that much higher with all of the overhanging headwinds in Europe and here in the political dysfunction we're having here in the States.
And there has been plenty of that. All right, Jeff Hirsch, the editor of the Stock Traders Almanac. Your dad, I believe, started at Yale, Hirsch.
Yes.
And now you've taken it over. Great to have you. We appreciate all your insight.
Always a pleasure. Thanks, Al.
All right, we'll do it again.